let's first take a look at De Leon's balance sheet. So as I'm talking, why don't you just take a look at these numbers and see if anything jumps out at you. Is there anything that seems remarkable? So this is the left-hand side of the balance sheet, just the assets. So first we have cash, and remember what we learned a minute ago about cash. Does what we heard about their cash position match what we're seeing? Remember, the middle column, or that first column of numbers, is the most recent year. So as you're looking through these, I would be comparing the 2014 figures to 2013. We are always looking to see where are the significant changes. So as I look at significant changes, I see cash has gone down significantly, accounts receivable has gone up significantly, inventory has gone up significantly, fixed assets have gone up significantly. Heck, everything has gone up significantly. But I'm most concerned about cash going down so much. But you know, this time around, we're just kind of, I don't know, taking an overview of the statements. Later on, we'll actually take these numbers and calculate ratios. But right now, we're just looking to see what's interesting, what jumps out. So, you know, I don't like that cash is going down. On the one hand, you could say accounts receivable is going up because, you know, that's a good thing because they're selling more. On the other hand, it could be that people aren't paying as quickly. On the one hand, you could say it's good that inventory went up because they need more stuff to sell. On the other hand, you could say maybe it's going up because they're not carrying the right stuff. And remember, this is a food company, so you don't want a whole lot of food sitting on the shelves for a long time. Fixed assets went up. That makes sense to me because they're expanding. They're getting bigger. So let's look at the other side of their balance sheet. Whoops, wrong way. And let's look at the liabilities and equity. So now on that side, accounts payable went up quite a bit. Accruals are up. Notes payable are up. So all of their current liability accounts, the stuff that they have to pay off within the year or within a year, has more than doubled, more than tripled, it looks like. Yeah. Long-term debt, more than doubled. Common stock stayed the same, so we know they didn't issue any new stock. And their retained earnings went down. Whoa! What does that say to you? Because you should have had accounting already. How does the retained earnings balance change? Think about that for a second. The retained earnings balance changes as we add the net income to retained earnings each year as we close out our temporary accounts. So if the retained earnings balance went down, what does that mean? Think about that for a minute, or think about it until we get to the income statement. Hold that thought.